Hey everyone, welcome back. Today we're diving into a truly fascinating week in the global financial markets. We're looking at the week of July 13th through the 19th, 2026. This explainer is all about what I'm calling the domino effect. We're going to break down a week where a fantastic, highly anticipated economic event, literally the kind of news that initially sent waves of pure optimism across the trading floors, was just completely overshadowed and knocked down by escalating geopolitical events and a massive sector-wide sell-off. It's honestly a perfect case study in just how interconnected and frankly how fragile market sentiment can be. Okay, let's dive into this. Here is our roadmap for today. First, 3 global forces. Second, US stocks tumble. Third, the crude oil shock. Fourth, gold and foreign exchange. And finally, looking to next week.
Section 1. 3 global forces. Let's start with a satellite view of the macro events that set everything in motion. Look at this number, negative 0.4%. This was the headline that kicked off the entire week. The U.S. Consumer Price Index for June came in way softer than anyone expected. Headline inflation dropped from 4.2% down to 3.5%, and core CPI fell to 2.6%. But this month-over-month drop of negative 0.4%, that is the real star here. It's the first monthly CPI drop we've seen in 6 full years. Initially, this sent a massive, deflationary shockwave of optimism straight through the markets. Investors practically tripped over themselves to price in an aggressive pause on Fed rate hikes. But you know, that optimism, it really didn't last. The market set up the first domino with that deflation shock, expecting a smooth, easy rally. But then, 2 completely distinct forces came in and knocked it right down. The second domino was a sudden, severe military escalation in the Middle East involving the US and Iran. The third was a violent realization regarding AI infrastructure spending, which triggered a massive tech sell-off. These 3 forces basically collided midair to create some extreme volatility.
Section 2. US stocks tumble. Let's move to the trading floor and see how this builds from the macro view down to the actual indices.
Here's exactly how that collision of forces played out across the major US indices. Early in the week, things actually looked pretty bright. Financial stocks were booming on the back of that soft CPI data and some incredibly strong Q2 earnings. We're talking JP Morgan Chase, Goldman Sachs, Bank of America, all posting record results tied to AI investments and banking fees. But despite that strong start from the Dow components, all 3 major indices ended the week down. The S&P 500 closed at 7,457, which was its first losing week in 3 weeks. But look at the Nasdaq. It took the absolute hardest hit, dropping nearly 4% to close at 25,520. Just brutal.
Now, what's really interesting about this slide is the sheer speed of the psychological shift. See that sharp midweek reversal? We went from extreme CPI-fueled optimism straight into a risk-off panic. By midweek, the whole narrative flipped on its head. The market completely stopped looking at cooling inflation and started glaring directly at tech valuations.
And here are the specific casualties of that risk-off sentiment. The semiconductor and AI sectors faced a relentless wave of selling. Heavyweights like Nvidia, AMD, and Intel all plunged, which completely dragged the Philadelphia Semiconductor Index down with them. The core issue? There's this growing investor fear that the current pace of AI infrastructure spending is, well, unsustainable. And it wasn't just the chipmakers. By the end of the week, Netflix dropped by double digits after forecasting slower growth, and IBM took a major hit after issuing disappointing profit guidance. That intense selling pressure totally wiped out the early week rally.
Section 3. The crude oil shock. Now let's shift our focus to the commodity that had the most cinematic reaction to the week's events.
Crude oil was the absolute strongest performing asset this week, surging a staggering 16% to hit its highest levels in over a month. The catalysts here are strictly geopolitical. We saw a severe escalation in military tensions between the US and Iran. Impartially speaking, the specific drivers were the US reestablishing a naval blockade on Iranian ports, a fresh wave of airstrikes, and very significant threats regarding transit and supply disruptions right through the critical Strait of Hormuz and the Red Sea.
Just look at the sheer volume of green on this energy heat map. It perfectly captures the massive influx of capital fleeing into the sector. Brent crude spiked over 4.5% daily to close the week at $88.10 a barrel, and WTI followed right behind, closing at $82.49. And you know, when oil spikes 16% in a single week, it sets off a huge chain reaction. It instantly raises inflation fears, it lowers expectations for global rate cuts, and it puts massive pressure on global manufacturing costs. It's a huge headwind for the broader economy.
Section 4. Gold and foreign exchange. You'd think everyone would just rush to traditional safe havens, but these extreme swings created a highly complex environment.
So the crucial point is understanding the absolute paradox gold faced this week. It was essentially caught in a giant tug-of-war. On one side, despite that really soft CPI data we talked about, Fed Chair Kevin Warsh testified before Congress and explicitly stated the Fed has zero tolerance for elevated inflation. He maintained a super hawkish stance. That raises expectations for a potential rate hike in September, which obviously increases the opportunity cost of holding non-yielding gold. But on the exact opposite side, you had massive safe haven demand exploding from those Middle East geopolitical tensions.
This chart perfectly visualizes that struggle. Notice how gold initially lost that tug-of-war. It suffered its sharpest drop in 6 weeks, falling about 3.5% and dipping below $3,960 an ounce, as bond yields and those hawkish Fed expectations just overwhelmed it. However, if you look over at the far right of the chart, you can see a real technical recovery. During the July 18th Asian session, it managed to claw its way back just above the crucial psychological mark of $4,018 an ounce.
And we saw a remarkably similar pattern in the currency markets. This is the US dollar index, the DXY. The dollar initially weakened right in the middle of the week, reacting exactly as you'd expect to the soft CPI data, hitting a 1-month low. But much like gold, it found vital late-week support. As the Middle East tensions escalated and the tech sell-off got worse, capital flowed right back into the dollar as a safe haven, bringing it back to close the week totally sideways.
Just to quickly touch on the broader currency and crypto landscape. The Japanese yen remains under severe pressure, trading around a historically weak 162.4 to the dollar, mostly driven by that massive US-Japan interest rate disparity. The British pound, meanwhile, actually benefited from the temporarily weaker dollar and expectations that their central bank will keep rates high. And Bitcoin? It had a wild, choppy week. It initially popped on the CPI news but couldn't hold the momentum as the global risk-off panic took over. It spent the rest of the week trading sideways around $64,000, just stuck in a narrow band waiting for a new catalyst.
Section 5. Looking to next week. Let's talk about exactly what should be on your calendar.
And this brilliantly illustrates the dominoes that are left standing for next week. First, the Q2 earnings season continues, and it is going to be critical. Alphabet, Tesla, and other big tech names are reporting. Their guidance is going to entirely dictate whether the Nasdaq recovers or if this tech slide gets even deeper. Second, we need to monitor upcoming speeches from Fed officials. Will they keep echoing Chair Warsh's hawkish tone, or will the soft CPI data finally soften the rhetoric? And of course, any further developments in the Middle East will instantly impact oil prices and global risk appetite.
But I want to leave you with this final, pressing question for the week ahead. Will gold hold the $4,000 mark? I mean, it fought incredibly hard to reclaim that psychological level by the end of this week. But with big tech earnings threatening even more market volatility and the Fed holding a super firm line on inflation, gold's resilience is going to be severely tested. Keep your eyes on the charts, stay focused, and we'll see how these dominoes fall next week. Thanks so much for joining me on this explainer.